Welcome to the Skilled MBA Finance Case Study Series, where we explore real-world ventures that embody financial innovation, strategic thinking, and long-term value creation. CoVenture has emerged as a dynamic force in modern finance by blending two traditionally separate strategies, venture capital and private credit. This hybrid model allows CoVenture to provide tailored financing solutions to fintech companies at various stages of growth. Rather than relying solely on equity, CoVenture structures debt financing backed by fintech-specific assets, such as consumer receivables, recurring revenue, or digital transaction flows. This approach mitigates downside risk while enabling startups to scale without excessive dilution. By aligning capital deployment with the asset-backed economics of fintech platforms, CoVenture enhances capital efficiency and meets the evolving funding needs of an increasingly digital financial ecosystem. It's a model that bridges innovation with risk management, two pillars often seen in tension. This case highlights how financial engineering, when thoughtfully applied, can unlock growth, preserve ownership, and create strategic value for both investors and operators. CoVenture exemplifies how alternative finance can evolve in sync with the industries it supports. CoVenture's asset-backed credit approach involves structuring debt financing secured by fintech assets. This model allows fintech companies to leverage their receivables or loan portfolios as collateral, providing them with necessary capital without diluting equity. By focusing on asset-backed structures, CoVenture bridges the gap between traditional venture capital and debt financing, offering a tailored solution for fintech growth. Traditional venture capital often demands equity dilution and high returns, while debt providers require proven track records and conventional collateral. This leaves many financial technology companies, especially those with receivables or loan portfolios, struggling to secure necessary capital. These platforms face a funding gap, hindering their ability to scale effectively. CoVenture bridges the financial technology funding gap by identifying promising financial technology companies with robust business models. They structure asset-backed credit facilities, leveraging receivables or loan portfolios. Continuous performance monitoring enables scaling, providing additional capital as success is demonstrated. This strategy allows financial technology companies to grow without equity dilution, while CoVenture enjoys attractive, risk-adjusted returns. CoVenture utilizes special purpose vehicles to manage fintech-originated assets, with institutional investors supplying senior capital. Robust credit enhancements, including over-collateralization and first loss provisions, safeguard investors. This strategy aims for mid-teens returns, providing superior downside protection compared to traditional venture capital. Fintech assets financed include consumer loans like personal loans and buy now, pay later options. Revenue-based financing supports small businesses through future revenue streams. Real estate-backed debt involves short-term property loans and rental platforms. Factoring and invoices are managed via digital platforms for invoice financing and accounts receivable. Credit structuring involves over-collateralization, ensuring asset pools exceed loan values, and first loss protection, where fintech platforms absorb initial losses. Performance triggers restrict draws if metrics decline, while waterfall distributions prioritize senior capital payments. Reserve accounts cover defaults, and data-driven monitoring tracks performance in real time. These strategies enable CoVenture to fund early-stage fintechs with robust risk controls. A fintech platform offers capital advances to e-commerce businesses using verified sales data. CoVenture provides a 500 million rupee credit facility, structured as a senior subordinate special purpose vehicle, assuming the first loss position. Risk is mitigated through daily remittance, application programming, interface sales verification, and merchant diversification. This approach enabled the platform to scale to 2 billion rupees in originations with sub-2% default rates. CoVenture employs a multi-layered risk assessment framework. Platform risk evaluates management, technology, and operations. Asset risk focuses on underwriting quality and default patterns. Market risk considers competition, regulations, and economic sensitivity. Structural risk examines legal documentation and collateral security. This approach emphasizes forward-looking indicators, crucial for platforms with limited operating history. CoVenture faces strategic challenges in scalability, ensuring credit quality while expanding assets. Competition intensifies as more capital providers enter financial technology lending. Market volatility requires structuring resilient facilities against economic downturns. Navigating evolving regulations across jurisdictions is crucial for sustained growth and compliance. India's fintech market is rapidly expanding, with projections showing significant growth from 2022 to 2025. This presents substantial opportunities for asset-backed credit providers like CoVenture, especially in digital lending where capital needs are high. Leveraging this growth can enhance CoVenture's market position and drive innovation in financial services. Expanding into Southeast Asia and India offers fintech firms access to markets with limited traditional financing but thriving innovation. Exploring new asset classes like crypto-backed lending and embedded finance platforms can diversify offerings. Institutional partnerships with banks and asset managers enable co-investment opportunities, providing fintech exposure without direct origination capabilities, enhancing growth potential. Structured finance in fintech involves applying securitization to early-stage companies with evolving assets. Risk management frameworks are crucial for assessing credit risk in novel models lacking historical data. Understanding capital structures is vital for fintech growth. This case offers insights for investment professionals, entrepreneurs, financial institutions, and regulators exploring new digital finance models. CoVenture is revolutionizing fintech financing by merging technology with capital innovation. Hybrid capital models blur equity and debt lines, while data-driven lending enhances risk assessment. These advancements are broadening financial inclusion, providing capital access to underserved markets. This evolution signifies a transformative era in fintech, reshaping traditional financial landscapes. Skilled MBA's case series offers innovative studies at the crossroads of finance, strategy, and technology. These resources are crafted for emerging business leaders, providing insights into modern challenges and solutions. Access our full library for comprehensive case studies, teaching notes, and more to enhance your strategic understanding. Thank you for exploring this finance-driven case with Skilled MBA. For more practical insights and case study videos, mobile, +91 875 53 0 0795. Email, support@skilledmba.com. Website, https://skilledmba.com.